Yeah.
And we're live. Okay. Just to check, could you guys tell me if you hear the audio from my computer?
That's for the futures contract in the U.S. market. If you're outside the U.S. and you're using an NT4 broker,
We can.
You can? Alright, awesome. How many of you guys are actually studying ICT? Like watching his videos? There's some other channels as well that I liked watching when I was studying at first. What was his name? T-Trades. This guy. We're on the come up though. We're gonna be making videos better than this soon. Everyone that joined, make sure you mute your mic so nobody else hears your background. Or I'll have to mute. And you won't be able to talk if I have to mute you. So try to mute that on your own. Miran, your mic is loud. Okay. Yeah, this is another guy that does pretty good with ICT concepts. We're also starting to make videos. We're going to get better at that. Trying to make them more high quality in shorter time periods. Like this guy's videos are pretty nice. They're pretty short. Also goes over the stuff. But you want to learn it always directly from ICT. Because even like me and Christian and this guy, like sometimes we get it off. Like sometimes we'll say something that's not exactly accurate or exactly how ICT meant it, and you might learn something better like learning it directly from ICT. Christian, you ready? You got better Discord downloaded? Doesn't look like he's in here yet. What is that? This guy has some attitude, huh? He's not even in the call, is he? Oh, yeah. Not watching vids. Just your PDFs plus homework. Yeah, VIP, we do some homework for them. But it's going to be kind of like that if you guys just study. ICT also gives you homework if you, like, do his videos. He'll tell you what to look for. We figured it'd be too long if we actually watched the entire video, so what we're going to do is we're going to skip through, and whenever we see something significant on his charts, we'll let him talk and go into this specific moment. Especially on like live price action. I'm just going to be doing it on gold if you guys want to follow along. Just the most recent price action. We had some crazy shorts after finally running to all-time highs a few times. But straight up, just looking at like this chart right here, what do I notice is this green like square right here is a higher time frame for value gap. Then he's now on the lower time frame. He's on the 1 minute chart right here. You always want to look at the time frame that he's on. Like that way you see how he kind of scales down from top to bottom. So here we have a fair value gap. So first he looked for a draw into this fair value gap. He got the run from that fair value gap, and he waited until he got a run with a fair value gap here. So he got that run with the fair value gap. It also ran above this high right here. You see these 3 down close candles? That's why he marked out this right here and actually used this one instead of this run here originally. This one is also valid because this first move right here, these down close candles, when it ran above those, that also created an order block. So this is an order block range, this is an order block range. Okay. I'm going to turn on the captions as well. Right, so here, these 3 down close candles, once it runs up above that, those become an order block range. And you can see that it didn't actually come below this low. It's also an order block and a fair value gap. So this is like 2 confluences in one. But he waited over here for it to run up above this high, creating another order block range. Then once it retraced back into it, he probably just took longs from this first fair value gap, the smaller one, on the 1 minute time frame. Ran up another fair value gap here that it consolidates within, and the candles don't close below it. So he always says wicks do the damage, bodies tell the story. So even though wicks come below it, and sometimes in like price action you'll see like really huge wicks like down here. That's called institutional order flow intro. It runs down and fills the fair value gap completely, but the candle actually pulls back up and closes at the like midpoint or at the bottom of the fair value gap. It's still valid. And then what I also saw that he didn't mark out is this right here, where my arrow is right now, on the left hand side, from the bottom of this wick to the top of this one. If you were to draw that out, this is now a disrespected bearish fair value gap, which is an IFEG. So that was another confluence that he didn't even mark out, but that's something that I would be using. There you go. I'm from India. Can I be a funded trader? Everybody could be a funded trader. But I noticed a lot of people from third world countries, they can't actually afford the accounts, you know? And they're trying to, like, they're rushing so much into trading. Like, trading is really, like, something that you want to do when your mind is clear, when there's no debt to your name, when you have no responsibilities, like when your job covers everything else and you can purely focus on trading. But if you're using trading to pay off debts, if you're using trading to, you're just trying to make a living when you don't have the money to afford the accounts, you're going to put yourself in a deeper hole. Some people even message me and they're like, yo, I'm in 500 debt from trading. I'm planning to buy another account. It's like you shouldn't be buying an account when you're in debt. You should get a job, get your way out of debt so that your trading is like purely focused on just like making that weekly percentage and not actually covering any responsibilities that you have. Yeah, I am recording it. So this is being streamed on YouTube. Can I make 100K with a funded account? If you have a 100K account, then you can start scaling up. Like you can make 2 to 3%, which is like 2K, 3K a week. You can start doing that. And if you can do that profitably throughout the year, I wouldn't say that you should stick to one account and try to make 100K with just one account. Once you get like a few $1,000s in payouts, you should buy more accounts, try to pass more accounts, get 300, 400, 500K in funding. Then you can be on your way to make 100K. Like there's people that make 20K, 30K a month. Even I'm not currently at that level. Like I'm stopping on my accounts at 2-3%. And that's totally fine for me. I don't have much responsibilities. I'm still building that portfolio. I'm trying to get more accounts with my payouts. So there's no rush. I'm not trying to risk it. I'm not trying to go for 20% when I could just stop at 2% and spend the rest of the week trading, studying, mastering that psychology. Christian, are you in here? You good?
Yeah, what's up?
Okay. Just making sure. Let's hop back into the charts. Let's listen to what he says about this specific price action here. So,
as a student that studies the things that's on this channel, I'm not a one-trick pony. I'm not a one-model trader. I have lots of trading models, and these concepts are offered by me. So when I code these things are at my disposal. I can reach and use them when and how I want to use them. So you as a student of the market and looking for utilization of these concepts, you're going to try to gravitate to what makes most sense to you. Okay, and when we're watching price in a few minutes, when we get into the actual replay of the real-time data, the video I showed, the little tiny little vignette, sped up to like 2 minutes and some seconds or so. The little vignette that I had, I sped up was like an hour and 20 minutes or so, compressed down inside of 2 minutes. Okay, so very, very quick replay of all of the actual executions, the annotations, and then now when I get done doing all this preamble here, we're going to walk through it again, but it's sped up to, but it's a step to that, but longer. Okay, so as every individual 1 minute candle, as you see here, paints, the candle has to close, and then another one begins. Okay, so it's real easy to get tricked into thinking, oh, this is real easy to hold on to because it's a 1 minute chart and it's going to be fast market. It's still time. Okay, so time has to be paid, okay, with patience. And if you don't have that, or if you just think that you're going to watch the videos, and I'm seeing a lot of frustrations in the comments.
Okay, so just going over what he just said right now. He said that he's not a one-trick pony. He likes to talk about himself in like this egotistical way sometimes. But what he means is like he doesn't have one model, and neither should you. Like I have a bunch of models. You might have seen me talking about like different models. I have my Asia Session Breaker. We have Lund Trade model. We have Quarterly Theory. We have London Session Fakeout, London Session Silver Bullet. We have New York Silver Bullet. We have the expansion inside the Quarterly Theory. There's so much different models within each one of our like strategies that we can like take a trade and go into, like if we take a loss, we're not going to let ourselves beat up about that and then journal a losing day. Like if you get into your head after taking one loss for the day, it probably means you over leveraged and you don't like, you can't see the market. Because if I was to take a loss, like say right here, I'd know that I was trading from a like premium for value gap for a buy. When for a buy, you actually want to be trading from a discount for value gap. So I wouldn't beat myself up. I'd wait for the next time opportunity, the next macro. And that's when I would enter that next trade. So I can still potentially make up that profit for the day. And what he was saying about 1 minute candles is that people go on the 1 minute chart and expect it to be like really fast movement. But what he means is like, even though you're on the 1 minute time frame, it's still like price needs to be respected. He said price needs to be paid. Like price still needs to be respected of the higher time frame confluences. So yeah, we have the 1 minute, right? But then there's also the 30 minute and the 1 hour. And it can consolidate in here on the 1 minute until the 1 hour candle closes. So you can't just expect 1 minute to run in and run out of places. It will still respect the higher time frame. So if we hop into the charts, let's look at this example. So right now I'm on the 30 minute. Let's go to the 15 minute. Okay, so we have a fair value gap right here. It's a bullish fair value gap that was disrespected. That becomes an IFVG, inversion fair value gap. Right? And now let's go on the 1 minute time frame. So we have that 15 minute. So if you guys look back at the 15 minutes, you first have to wait for it to close here. And then it closes and runs back up from there. So on the 1 minute time frame, you can see that on the 15 minute, it ran straight away from it. On the 1 minute, it came up into it. You might have sold at the midpoint, ran up, and if your stop loss was tight because you were expecting a run from it, it was still respecting the 15 minute candles. So it first had to run down here and close before running back up into it. So this one was an invalid one right here. But it's all composed of like the higher time frames. You have to respect the 1 hour. You have to mark out any 1 hour fair value gap. So we have the 1 hour here. So it'll always respect the higher time frames first. Also for VIP students, when we were talking about institutional order flow entry, Joe, that's for homework number 2, I believe. This is one example that you can look at. This is gold price action. We have a perfect fill of this fair value gap, and wick runs back down and closes below it. That's institutional order flow entry, Joe. That just means that like it's like institutional. The hedge funds, they got their orders in at the inefficiency where there was only sellers. They bought up into it and got their premium entry. That's why it's called institutional order flow. But you'll notice it by just looking for that wick. Okay, let's hop back into this.
Which I also disabled, but forgot to turn it off for the small little vignette. The only reason why I put the vignette up is because I forgot to put my watermark on the video, and I shared it on Twitter, and a lot of folks like to know on Instagram, Facebook. There is that buy side imbalance, sell side efficiency, that single candle right here. I'll move it out of the way. So you can see, and that down closed candle, which is on the 5-minute chart, you can see that is what it's anchored on. So as I mentioned before, and you're going to see a lot of things not actually be in my chart because I'm working with 5-minute charts real time, showing you that there's an algorithm. Yes, you can read it. Yes, I'm getting a feel for where the market's going, but I'm not trying to absolutely mark up everything because, as a reminder, I only have the time to see, identify, calculate, process, envision what it is the algorithm is going to do next, all at the same time that 1 minute candle and 5-minute candle is painting. Okay, so in real time, when we do our live sessions beginning February 7th, I don't have the luxury of always typing things out. And I won't have to because you'll be there to see as a component when I see people. It's not going to be like that at all. It's going to be me pointing. Okay, don't worry. So we have a buy side balance, sell side efficiency. Okay, yes, we went down, but we left a small portion open, so that means it's always a candidate to come back and revisit that area. And if it overshoots
Okay, so what he just said is that we left a little part of it. Do you guys see this wick? So the wick didn't run all the way down like the candle I just showed you in gold, like where I said it was called institutional order flow entry. That candle that I showed you filled it all the way. But here he shows that this candle, it ran down and filled some of it, but it ran a little bit. So what he's saying is that it leaves room. So when there's a fair value gap and it, runs into it like this, but it misses the midpoint, that leaves room for price to run to the midpoint. It runs to the midpoint, runs back up. But it didn't fill it completely. So that leaves room for price to come back down into it and fill it completely before running back up. Just because it comes back down deeper doesn't mean that you're bearish. It just means that maybe it wanted to fill it before running higher. So sometimes price runs from the midpoint, consolidates, building some liquidity up here to be swept. Then price runs for the lows of this liquidity, fills this fair value gap, then runs for the highs. So that's what he means by it leaves room right here. The wick didn't completely fill the fair value gap.
That's fine. Order block on 5-minute chart is always a possibility. Okay, so we traded down into it, completely closed and hit the order block.
Yeah, there you go. There's the example. So it ran all the way down, filled it, ran up for the highs. That was his model, like exactly what I just told you. So let's look at this before he starts talking and see what he marks out. So speed bump, he just means because of this big wick, he just wanted to isolate it into multiple areas of partials. Right, so first run from here, we got that order block, fair value gap, second run, and his partial was at the high of this before the wick, and his second partial was here. So he said he sold 2 contracts right here, 3 contracts right here, and then finished his order right here at the highs, relatively equal highs. So I mean, even if you just use something like irrelevant right here, I wouldn't really pay attention to the highs of candles, but you should build like a system that takes partials, because like maybe you would have had a run down here to these lows and you didn't take partials and your stop loss was right here, and this huge wick, again, institutional order flow entry, runs up, takes you out. You're upset now because you could have taken partials, but you didn't. You could have taken partials from your entry here, sold off some partials here, and you wouldn't have been that upset. But you wanted to hold all the way down here. So that's the reason you should be taking partials. Now let's listen to what he says.
And then we entered into the 10:30 to 11 o'clock time window. And we dropped down initially right at 9:30 opening. 9:30. Right there. So at 9:30, we had sell stops below here. They tagged those, came back up to the buy side, buy stops here, and then notice they left these relative equal highs open. Now the reason why I'm keeping all these notes here is because I want you to see this is the actual chart that was annotated in real time while I was executing and managing the trade. So while it is a little too busy here, I'll clean it up when we get to the need for doing so. But right now, it needs to be there for context. So we left buy side liquidity, that's buy stops, above these relative equal highs. Now, traders are taught that this is resistance. So therefore, lower prices should be expected. And we did. We had lower prices, but down to a level of a discount. And my expectation, much like I was sharing with the ES, there's a daily volume imbalance up here in that shaded area. So I thought that was a draw on liquidity. So that means what? even though we have movement lower at 9:30, going into 10 o'clock hour, it's going down to go up. And because it's FOMC and it's also the non-farm payroll week conditions, and I say week, not W-E-A-K, W-E-E-K, the week, Monday through Friday. Because it's non-farm payroll week, that tendency to be sloppy in price delivery, it's not as precise. Targets won't really get filled perfectly, or maybe not even get touched at all.
Okay,
I'm going to show you how
this is important. A lot of you guys still don't understand like news, red folder news, and what is non-farm payroll. One of the things that you guys can like remember and have it stick with you in your like trading journey is knowing that non-farm payroll is the first week of every month. So right now it's July 19th. So we're not going to have any non-farm payroll anymore because it happened in the first week. But you'll know that August, the first week of August, it's going to be non-farm payroll again. So every first week is when you have non-farm payroll. You just go on calendar, Forex Factory. I only have orange folder because we had 2 days without red folder news this week, so I selected orange folder news as well. But typically you only filter it to red folder. Because the reason I added orange folder is because we had no news on Wednesday, like red folder news. So I was like, okay, we're not going to have anything affect price. But then there's this FOMC member Waller speaking, and it completely messes up my trade because it just runs like crazy. So on days that you don't see that news, you can check the orange folder just to kind of be aware of it. But typically what you'll see is red folder news like this. It happens on Friday or Thursday of the first week of every month, and it says NFP. On weeks like that, you just kind of stay away from the charts. You can start trading the next week.
The US 100 for non-US traders actually went to its daily volume balance. So it'll be hopefully an encouragement for you to study real time using the US 100. So you don't necessarily have to have real time data. And I'm taking the liberty based that one candle over here. That's your fair value gap. So let's add it back. And the way I did that is click on it, highlight it, hit the delete key, it takes it off. And then when you want to back, just hold up Control and Tab Z. Okay, so undo that in case you want to know. And then the market ran away above this fair value gap. And I mentioned that I wanted to see price stay above that, and it would not go back below that. It's not needed to. Okay, and I'll get into that when we're doing the live walkthrough of the trade execution and management. But I want to cover why I chose the NASDAQ today versus the ES. So if you probably noticed this down here, okay, it's a real secret indicator. Now, only the best hedge fund traders, market makers, the elites, the folks that pull the strings that make the markets go up and down, they have this indicator down here on their charts. I know it's hard to believe, right? It's hard to believe. Yeah, I'm just being facetious. If you look at this, and we're going to add the use of the ES. Okay, so all I did was compare. And if you're using...
Yeah, you guys can actually add another chart to your screen and look at both of them at the same time. This is a concept some of you guys can be or might be familiar with. Christian trades it a lot because he trades NQ and ES, but it's called SMT divergence, and you're looking at two pairs basically to see that divergence, like where one may sweep the low, the other one doesn't sweep, and it shows you extreme signs of bullishness.
Trading view up in the upper left hand corner up here, you're going to see like a little plus symbol. If you click on that, that's your compare.
Oh yeah, be sure to send your questions in the Discord chat. So we have this chat right here. Somebody said turn off the captions. Okay, I'll turn it off. Anyways, yeah, send your questions in the Discord chat, and I can go over it after. Christian, also say anything if you want to go over this. He can go over SMT for you guys.
Yeah, so basically, almost all proper reversals or especially market maker buy models or sell models, they're going to actually start with SMT. And basically, like, if you struggle with actually finding a setup, this is like your route to to easily identifying good setups in the live market. So um, right now, Mark's pulling up the S&P 500 and Nasdaq, and so basically we're comparing. If we're bearish on the day, we're comparing highs, and so if Nasdaq is making a higher high and the S&P fails to, we're gonna look at that as a sign as the S&P was very bearish on that day, right? So when we see that happen in live price action, after we create a SMT, we're actually going to be looking for displacement, and as soon as we find displacement, market structure shift, we're able to get in on that trade.
Yeah, so just looking at the chart itself, like there is no SMT right here. It's pretty close. But notice how the price moves like symmetrically. Like it's both running towards sell side. It's both pulling back up here. That's because like price action on both of these is based off of the US dollar. So you can look at pairs like this. Also Euro USD and Nasdaq. Somebody's mic isn't muted. What is better Forex or futures? So right now I'm showing you guys on Forex, right? NDQ 100, S&P 500. But if you're going to be trading these, it's probably preferable that you use the futures version of them. So if you're trading with like a futures prop firm, for example, you want to be using the futures version. It's also more precise and there's no spreads on those prop firms, which is pretty nice. So I think right here we have an SMT divergence.
Yeah, you want to look at just like the 15-minute time frame on Nasdaq and ES, and you'll see from Friday London Open, we actually take out the high on Nasdaq, and then we don't take out a high at that same time. We don't take out the high on ES.
So right here's an example. You can see that here we had a little high created, so that's the same high as right here. You guys see this high? So on S&P, we didn't actually run up for it. So we failed to sweep it, but on NQ, we ran up and swept that high. That's an SMT divergence. That's kind of showing you like extreme signs of bearishness. So then it pulls back up into what? And we have a fair value gap right here. That's your additional confluence. Boom. That's your 1 hour time frame. Then if you guys want to add that third confluence, you just go on a lower time frame right here. Got the 30-minute. You look for a bullish fair value gap that gets disrespected. Let's look for that. I mean, we have this one, but that's too far in the premium. And then we have this one right here, 30-minute. So there's the three confluences. I sent this out in Telegram not too long ago. Not this example. I mean, I sent out what ICT said, that you want to have at least three confluences before you place your trade. So that's your three confluences. We have the sweep of liquidity. We have the SMT divergence, right? So this is extreme signs of bearishness. We have the 1 hour bearish fair value gap, right? The normal fair value gap. We get the run below it, and we get a close below a bullish fair value gap. We disrespect it with this candle right here. You wouldn't enter here because it didn't close below it yet. But once it closed below it, then you can wait for a pullback and enter in it. Secure your stop loss above the fair value gap and go in for the relatively equal lows right here. Look at that. That's a beautiful trade. It's so clean. You have SMT. You have equal lows built up right here. You have the 1 hour fair value gap. And you have a disrespected bullish fair value gap that it taps into right here. That's beautiful. That's your three confluences. This is all you need.
Yeah, you pretty much hit it on the dot. That's the trade that I sent out today. And a lot of people were actually looking for longs, but you look at that 1 hour and we're perfectly respecting our fair value gap. We have equal lows, and everybody's looking for TGIF when we haven't even hit our final target for the week, right? So this is one of those times where on Friday, you're not actually going to be looking for TGIF. You're looking for a continuation of the week.
Yeah, look at that. That I didn't even know because I didn't take a look at it. I only saw the TP hit earlier this morning. But yeah, see, it's what like I just saw on the chart just from looking at it, and it's exactly the trade that Christian sent out today. We had the SMT. Boom, took the entry towards the equal lows right here, and that's where he exited the trade. TP hit at 160.
ES H20.
So once you guys understand this stuff, you'll be able to see the exact same trades as us. And if you trade on the same pairs as us, then you can even send us the trades. We can correct you on what you could have also added to your charts, what you could have ignored, why, what was the narrative instead. And when you take a loss, we can say, okay, I get that you were selling because you saw this move right here, this bearish move. But just because we got a bearish move, that doesn't mean the bullish narrative is disrespected. That just means that now we have a bearish leg to use as a IFEG.
3, and it'll plot over, well, you gotta click new pane, P-A-N-E, and then it'll plot it below the instrument you have open.
Yeah, when you, like I showed you guys, you click new pane. I think you might need the premium trading view to do this. But you just search it up right here. And then instead of clicking on it like this, where it actually pulls it up, you press new pane and it'll add it to your chart.
Since we're talking about NASDAQ, which is NQH2023 for the symbol in trading view, you would be plotting it down here. Now for non-US students, you could be utilizing the US 100 up here, and then hitting the compare feature up here. It has a little plus symbol on trading view up in this area. Look up on when you're doing your pause the video if you want to go and see what I'm talking about.
He's just telling you guys about the futures pair. So we have E-mini NASDAQ 100, and then for the name of the E-mini right here, we have ESH 2023. So there's specific names for those futures pairs. You can ask Christian to send it to you if you are looking to start trading on the futures. But if you just get a futures account, then it'll automatically be there for you guys.
Slightly higher than the high. See that? ES is not showing the strength to the upside that NASDAQ is here. So keep marching forward.
Another thing that's significant, he just said that he was looking at this little high right here. So NQ ran up and swept this with this wick, this high, this low internal liquidity. Like that's not an entry. He's just looking at it to observe price action. This is how, like I made a post on Instagram recently on like SMT divergence and how to determine the dominant pair was a question that I got a lot. This is how you do it. You just kind of look at it. Dominant pair will be more likely to run up and sweep the highs. So here we didn't get that sweep right here. We got a weak sweep. This one pulled down deeper. This one didn't. Extreme signs of bullishness. This one swept the low. This didn't create a low to sweep. So that's how you determine weaker and dominant pair.
And right there, we can see that this high and this high, NASDAQ is lower, but ES is higher. Doesn't mean anything yet. Watch what happens. We have now this short-term high that's been taken out by this high. This high is this high here for NQ. Okay, so NASDAQ's high is here on the 1 minute chart, and ES's 1 minute chart high is here. Over here, look what we have. We have relative equal highs. See that? But we have a stronger, higher punch through by NQ. So NASDAQ was higher here. After, here's the key point, a short-term high was taken, and then a fair value gap was left. Okay? After digging into this 1 minute by $7 so some efficiency, or gap, okay? And we expect the market to turn here. So we have relative strength analysis on our side that NQ, or NASDAQ futures, was the better buy. And again, why? The short-term high here is much more prominent of a break here than it is here. These are relatively flat. This, I'm looking for the relative strength leader. The one that wants to break out higher, faster, stronger, Okay, and
there you go. He's looking for the one that's going to run up higher. It's going to sweep that liquidity. It's going to run up faster. And that's exactly what happens. Like you see the price action, it keeps bumping up, bumping up. And so it's usually that dominant pair is going to run up and sweep the highs a little bit higher than the weaker pair. It doesn't look to be true in this example, but it could also be that these highs were like technically shorter than these highs were. So there was a larger pip range from the bottom of this to the top of this than it was on here.
while they both pretty much moved in.
Let's just jump because I don't want to spend too much time on the same price action. Okay, that was the, right here, you guys see that? The level I talked about earlier that he didn't mark out. I spoke too soon. There he did. He dragged it out. Look at where he drags it out from.
And the market trades down into this fair value gap here, and then leaving this range right there. You'll see if that's drawn, and I talked about how it's not going to go back below that. The algorithm will not reprice back below that. Why? Because this, in this area here, becomes a balanced price range. One single pass, and the fair value gap. So it's going to work in this one, and then accumulate new long positions. I even talk about how this area here with this fair value gap, I'm going to draw it again, like this. I even stated that you would see this form support. I typed it out and you'll see it again as I did it. And the only thing I was incorrect about, and this is typical of FOMC and also non-farm payroll weeks, where my precision is just a little bit skewed. This low right there, I looked at it as a potential to create an institutional order flow entry drill, which is just a small little
Institutional order flow entry drill. So he's saying that he was slightly wrong because he expected it to actually tap in on the low. So maybe he wanted to add a buy to his position, and he would have done so if it ran down and into this bullish fair value gap. But he says he was wrong about that. The wick, it was more bullish than he expected. And what he said about balanced price range is that you have this fair value gap here, right? And then this one here. Previously disrespected, and this one that it's staying within. So he was just like, this is a balanced price range. It's more likely to run away from it from here without having to dig lower into the discount here. This is also how you know sometimes when it sweeps highs, like what if you were bearish, right? So when it swept these highs, you were probably like, okay, I'm going to go into shorts. This is how you know that it's not going to reverse. It's not going to go short. That's how you know. So you would wait for a disrespected confluence and you'd actually go long instead. Aim for the next relatively equal highs. You want to add anything to that, Christian? And I'm going to look at the chat for questions.
Yeah, and as he keeps talking about this market maker market maker buy model, so each fair value gap is a distribution leg. So the lowest one, we have our first distribution, our second distribution, and as he talked about, it created actually a balanced price range on the second distribution. But what that goes to show is just because you miss the first entry, the first fair value gap, we're still targeting those highs no matter what. That's just the narrative. That's what's going on. And so with each leg, we have a new opportunity to enter. And I'd even say where he shows the balanced price range, that might be a better entry than the lower entry, just because we have more confluences going on. And there's nothing, at that point, there's really nothing stopping us from going higher. Because you could see pretty much all like large fair value gaps are taken out. And all that's left is that BPR and those equal highs.
Yeah, so like he just said, this could actually be an even better entry than the one down here. Sure, you're not going to get that larger pip range, but you still could have still gotten chopped up down here. It could have still swept the lows again, over and over again. Here, it's kind of like already confirming. First of all, you get this huge expansion. Second of all, you get a disrespected bearish fair value gap here. That's so much confluences. Then you have all these candles staying within this range. Boom. Light work.
movement into a fair value gap.
By the way, somebody just asked me a question that I get a lot. Right here. How to find bias. Where was that question? How to find bias. It's actually so simple. Like I always tell you guys, it's so simple to find bias. You just first of all, you have to learn the concepts. If you don't learn the concepts and you're slacking on this part, like if you don't know to this point what a fair value gap is, right here, we have a fair value gap. If you don't know to this point what a fair value gap is, then go study it. Go look at videos of it. Because you have to know what a fair value gap is. Then, to find bias, all you do is you go on the higher time frame. You find the higher time frame target. That's bias. Look, we have these equal lows, and we have a daily fair value gap. This daily fair value gap is your target. First of all, look at this. We close below this fair value gap. Barely, but we still do close below it. Right here. Bullish fair value gap gets disrespected. You guys see this? It closes below it. I'm going to try to zoom in on that. Closes below it. Next daily candle opens, runs up into it, and sells off. Boom. That's a IFVG on the daily. That will show you that you're already bearish for the next few days. Then you find the bearish target. Right here, we have a bearish day or a bullish daily fair value gap to aim for. Underneath equal lows. Isn't that simple? You just go on the higher time frame and you find that exact confluences that you're using on the lower time frame. Easy. So easy. But the reason you struggle, or you might have struggled with it before, is because you didn't even know what a fair value gap was. So go learn that. Like, I'm not even looking at order blocks or anything like that. Not looking at breaker blocks. Just fair value gaps. That's enough. Fair value gaps, liquidity. That will give you so much more edge than you already have. Let's go to the next price action that he shows. Okay, he shows the entry. Let's go look at that.
And try short the trade. Alright,
Okay.
so with everything I just outlined, all the logic as to why I'm anticipating it, I'm going long. Here, you can see the actual orders.
Okay, for futures, this is understandable. He placed his stop loss right below this fair value gap. Like, that's understandable for futures. But for, like, gold, for example, you might get a few more wicks. It's still insanely accurate. Gold's price action is insane. Like, people underestimate gold. But its price action is really clean. But you might get some wicks. So I'd recommend, like, starting off, instead of using 6, like, let's say instead of 6 contracts, you put in 3. And you allowed for a bigger stop loss. You'd be risking the same amount as him, but your stop loss would be down here. And you can give it more room to see what actually happens. Instead of taking a loss, getting butt hurt, and trying to take more entries, and then not actually learning what you're supposed to learn. If you take a wider stop loss, then you'll be able to learn. You'll be able to learn what happened, what you should have looked for instead.
And don't be discouraged by the 2100. That's actually 2.1% risk. Okay, it's based on a $100,000 paper trading account. And some of you like to choke on the fact that it's paper trading. But if you can't appreciate the fact that the precision elements are there with real-time data, because you can't do anything.
Yeah, I mean, even if it's price action, that's why I tell you to trade demo. Because even if it's like a demo account, you're still catching a live execution on the trade. Like, that's still so impressive. It's so much different to drop that expansion or that buy tool on TradingView that shows that you took a trade versus actually placing that trade there. It's way different. You have to be in the charts. You have to press the button at the right time, place a stop loss, and avoid getting that stop loss getting hit. That's impressive, even on a demo account. That's why you should do it.
With live data. So live data is the only way you're going to be able to do it. So you can't be faking it, you can't game it like MT4 and fake it like frauds do. So buy sell liquidity. That's where my initial draw on the market is. So this is the market maker buy model, and you can learn more about that in my Scout Sniper series, which is free on this YouTube channel as well. So there's the order block. I'm waiting for price to move away from that.
Order block simply because this black candle is the order block. This green candle before that is it basically shows you that it was bullish. Now you have this new bearish candle, and all it needed is to trade above this one. If this one was also a black candle, a bearish candle, then it would have to trade all the way above this high right here for the range to be a valid order block.
Stand above these relative equal highs here. That's buy side liquidity. So my eye should be, well, your eye should be trained over time, and now my stop is to break even. Because if it goes back below after running the relative equal highs where the buy side liquidity is written, that would not be a good thing. So I'm going to make sure I'm controlling risk. So I want to see this fair value gap, that pink area, act as support. Okay, so what specific level? The high of it. I want to see it expand above it. And as it's starting to go up, I'm watching how price is gravitating towards that rejection block. Okay, and I like the expansion that we're seeing here. And I'm not thinking that we're going to collapse into the other direction based on all the things I've already outlined. And there is a daily volume imbalance that's already shaded on my chart. You can't see it yet, but I'll scrub the video down on the axis, on the price axis, and you'll start seeing it in a moment. But I just moved to stop up. And I'm going to look to buy or pyramid more of this position as it drops back down into that fair value gap. When this candle closes, I'm anticipating a fair value gap to form. There you go. See, now I have a gap there. So I like that gap being there above the shaded area that's pink.
So what he's talking about is not only does it close above it, giving him an additional confluence to use, but not only does it close above it, it also creates a fair value gap right here. Remember the fair value gap that he outlined in the trade we were just talking about? Look, it consolidates within the range, but it's staying within the fair value gap. And that's why he adds another position right there, see? Because it's respecting it. Boom, adds another one from here. Because it's respecting it, it sweeps so low, he just adds more orders. So he's saying might want to pull down into this one. That's where he said he was wrong because it did just stay inside of this range. There you go, order block created. You guys see that? He marked out the black candle right here, bearish candle. Bearish candle takes the high out, then there's an order block right there. He's paying attention to how price treats newly formed fair value gaps. Boom. Sold off 2 contracts of his 10. Take off a partial at the first high. Next, 3 contracts sold here. He has 5 left. He's moving his break even higher. This is all like skills that you should watch ICT's executions for. You want to see how he reacts when it runs buy side. What he does, he closes partials and allows for more money to be made even if it runs down for break even. Boom, sold 3 more. And then he was also expecting it to run to this higher time frame inefficiency up here, this yellow one. So he doesn't care if it stops him out. And boom, taps him out. But his break even is already up here. He's fine with that because it was at the high. So these are methods of trading that you should pay attention to and use. Like people say, yeah, ICT yaps. But yeah, listen to that yapping and maybe you'll learn something for once. That yapping is good. That yapping is 20 years of experience. Yeah, this is how I prefer to listen to ICT.
All this is exactly how you would see it on trading moves you do it yourself. No trickery, no fraud, no making up, no MT4, rent MT4 servers. I don't do those things. Okay? People can't trade like me or that precise. They like me with all kinds of nonsense and stories to justify why some people should collectively come against me with hate or cancel us.
Facts. I think 1.5 is good actually.
CT. Well, if I'm going to do what I'm doing here,
yeah, that's fine.
Community, which in my game is more than anybody else, I could be making millions of dollars teaching. And I'm choosing not to do that. And I'm going to invest my time in all of you for free. Take advantage of it because I'm not going to be doing it again. So many people ask me to talk about real-time data, show it live, do this, all this. I'm going to do it for the entire year. And there's still going to be people doubting. So for an FOMC day, I call this satisfactory.
The reason why he says that is because on FOMC you already get that huge pip move just from the news itself. So you might not usually on FOMC if it gets an insanely large pip move. Some days on FOMC it might just consolidate. It might not actually run after the news. Yeah, that was solid. What did you guys think? Did you learn anything? Let's see your questions. Balanced price range is better than a fair value gap. It's not better than a fair value gap, but it's an additional confluence. When you have a BPR, that means you also have a IFVG plus a FVG. So yeah, it's a little more accurate to look for a balanced price range than to use just a fair value gap. So on gold, is it going next to fill the 2390 level? Yeah, so yesterday we also got like some nice buys. Remember, Steve came in clutch when I was in on the charts. He sent me a message in the VIP chat. He was like, let's see, where was that? Oh, whatever. I don't know where that was. Anyways, it tapped into the buy side of a bullish fair value gap, and we got in at 2,415. So that was up here. There you go. That was here, 2,415. Let's go on a lower time frame here. 30-minute. Okay, there was also a daily open, new day open gap, and that's exactly where it filled completely before running up. And we got a move all the way up to 2422. So we got an entry from 2415 up to 2422. That is 2415. 70 pips. That was the range that we got yesterday. I was honestly expecting it to run a little bit higher, but as you can see, it's more bearish than we expected. So let's go look at this chart now. Is it pulling to the 2390? That would be the next draw on liquidity, yeah. And look, we have 3 hours left of this Friday range. Friday is most likely to run into this daily fair value gap and close somewhere here. Also, you guys know TGIF. I was going over this with VIP. We drag the top to the bottom. This is an insanely huge wick, so it's not going to be as accurate to aim for the whole range. It's not going to be as accurate to aim for the whole range of the TGIF to retrace to 0.2 and 0.3. TGIF. But basically, it did still create this wick. So on normal weeks, it would pull back slightly and give you that wick, like this one right here, this week. So from the top, it pulls back into the 0.2, 0.3. See, it ran into the 0.2, and then it pulled back up. I remember that last week range. So this week's range, if it taps into this daily fair value gap, like if it happened earlier in this day, you could have, or maybe today during New York PM session, we'll pull into this daily fair value gap and get a little pullback. That could be your TGIF setup. But yeah, so because we disrespected this one again, we didn't necessarily disrespect it until this candle closes, but we ran so far away from it. So the next draw on liquidity will be this one. If this is where it closes and we get a pullback, maybe next week it closes below this daily fair value gap and we end up drawing towards this daily fair value gap. And not only is there this daily fair value gap down here, but there is also this weekly fair value gap. Weekly always dominates the daily because it's a higher time frame. It's going to be more significant. You guys see this? So if we do happen to begin running bearishly, this would be the draw on liquidity on the weekly. But I don't think so because we have the seasonal tendencies. And seasonal tendencies, we have the July as one of the most bullish months, and then following that we have August as an additional bullish month. So I was making a YouTube video on this right here. This is the seasonal narrative for XAUUSD. We have July as the biggest bullish month, and I was showing on the Telegram that we did have July as the biggest bullish month right here, at least out of the last few months, because this one was also pretty huge. So we have that huge July candle, and because it also says that, where was this? It also says that August is also going to be a bullish month. I'm still expecting it to run up for buy side again in August. So why? Because it's respecting that narrative. If it disrespected the July being the biggest bullish month, then I'd be like, okay, we're actually extremely bearish and we will have actually look for sell side. So when seasonal narratives don't follow the previous seasonal tendencies, then it's actually extremely in the opposite direction. That's going to be all for today's stream. Christian, do you want to add anything? And then drop your questions if you have any. We'll go over those before we end this live stream.
No, I think you hit it pretty well. Just again, I know a lot of people struggle with the higher time frame, but basically it's the same thing as the lower time frame. However, it's a lot slower moving because you're waiting for the entire daily candle to move. And so just using those inefficiencies as basically resistance and support, as ICT says, so inversion fair value gaps, just normal fair value gaps, to see where price is delivering, and using liquidity as our targets, we could develop our bias and just translating that down to the lower time frame, using our kill zones, using our macros. We could use that to actually target those higher time frame draws on liquidity, right?
Yeah, so like you said, using that higher time frame, this is a daily IFVG. We disrespected it, used it to go lower, used liquidity as our target.
If you actually want to look at the daily here on NASDAQ, you'll see this entire 2 weeks have been a market maker sell model. So if you go on the daily, it created a market maker sell model from the June 24th to now. We actually could have anticipated this sell-off going into from the high. We created a chalk candle, yeah, right there. So we created our change of character order block, and if you go throughout the lower time frames, like the 4 hour and the 1 hour, we could actually see that we create fair value gaps, we trade up into them and continue delivering until we finally hit our terminus today, which is that low.
So as we were talking about, there's 2, sometimes 3 price legs of accumulation, manipulation, move towards that higher time frame narrative being all-time highs. Then we have the same kind of accumulation towards the downside. Accumulation, manipulation, run towards sell side. Accumulation, manipulation, run towards the next objective. But yeah, just looking at this last day on the lower time frame, do you guys see this insane precision? We have daily inversion fair value gap, and it runs from the daily IFVG to the daily FVG. You guys see that? From here to here. And our entry model was just this fair value gap, SMT divergence, disrespect of the bullish fair value gap here, and run towards that sell side. That's easy. That's literally a perfect model. It's so clear. And that's why Christian was able to catch that trade today. It was clear. All right. Yes, sir. We're gonna have these pretty frequently because we don't have to prepare much for these calls. We can just hop in anytime and watch some ICT with you guys. Thanks for joining. Catch y'all next time.
Later, guys.